Hello and welcome to another video. Today we'll be looking at one of the best rules that I follow to make consistent profits in my trading. I call it my golden rule, and this is one of the main reasons why I am able to execute successful trades. There are multiple rules that we need to follow for trading, but this is one rule which helps me stay on the right side of things and basically prevents me from executing losing trades. So we'll go into the details of the rule itself. The rule is pretty simple. Most of you would feel it's common sense, but common sense is not that common when you're trading because you're dealing with money and emotions can come into play, which can basically force you to execute trades which you would not have executed otherwise. So it is extremely important that whenever you're about to hit the submit button for any order, you remember this rule and you make sure that you're following this rule for every single trade that you are submitting. We will also look at the different steps, the do's and the don'ts that you need to follow in order to apply this rule to your day to day trading. So, without further ado, let's get started. Before we proceed, a disclaimer here: whatever information I'm sharing with you is only for entertainment purposes. You can see my suggestions, and if you like them, then you can execute trades. But please make sure that you do your due diligence before executing any trades and you consult a financial advisor and you basically understand the risks if you are executing any trades. Whatever I'm going to explain is only for entertainment purposes and it is not any kind of a trading recommendation. So this is the rule, and you can see here, this rule is very simple, and it says when things can go wrong, they will go wrong. So essentially, whenever I execute a trade, no matter how much analysis I have done, no matter how much conviction I have that this particular trade is going to work out in my favor, I never assume that the trade is going to work out in my favor. I always work with an initial assumption that the trade will go against me, and therefore I should have enough cushion to protect myself so that I do not end up with a losing trade. Also, at the same time, because I work with the assumption that the trade is going to go against me, I already have a plan ready that I will be following in case the trade actually ends up going against me. So, this is extremely important in order to make sure that you are on the right side of things, that your portfolio is green, it's not in the red. Because if you have already made a plan as to how you will manage a trade in case it goes against you, then you will not panic. You will not have to research at the last minute what needs to be done in order to convert a losing trade into a trade which is a winner, or into a trade which is losing money but losing a very insignificant amount of money. So, this one rule, if you can follow, no matter how much analysis you've put in into a trade, how much conviction you have, how much confidence you have that a trade is going to work in your favor, you should always work with an assumption that the trade can and will go against you. Because most of the times when traders lose money, while submitting the trade, while executing the trade, they were super confident that the trade is going to work out in their favor. But eventually it did not do so. And because these traders did not have a plan as to how they will manage a trade and they did not manage their risk, they did not have enough cushion because they were so confident that the trade is going to work out in their favor. That's the reason why they end up with losing trades. And these losses can be so big that it can actually wipe out such a huge amount of your portfolio that it'll take a long time for you to recover with the remaining capital and make up for that loss. So it's always best to hope for the best, but then be prepared for the worst. And this is one trading rule that I basically use for myself every time I'm about to hit the submit button for any order. I have this running in my mind so that I ensure that my trading is always conservative, it's always defensive. I am not trying to fight against the market. I am not trying to push my confidence, force upon my confidence to the market because the market is going to do what it has to do. If you feel that a stock is bullish, doesn't mean that the entire market feels that the stock is bullish. Moreover, there are catalysts which can come in after you have executed the trade. Let's say you are bullish on a stock, and then there is some news, some catalyst around that particular company which has come after you've already executed the trade. That catalyst may be bearish and the stock may start falling down. If you are not planning any kind of cushions, that means you're executing a trade where as soon as the price goes against you, you start losing money, then you're going to make substantial losses. Also, if you don't have a plan as to how you will manage the trade or how you will adjust that trade if it goes against you, then you're going to panic and probably you will end up closing the trade at a far bigger loss that you would have seen had you come up with a plan beforehand. So now we will look in detail at the various do's and don'ts that I employ in my day-to-day trading to make sure that I always apply this principle to my trading. So the first thing, this is something which I have mentioned in other videos before as well, is the fact that do not make directional trades. I am not saying that directional trades don't make money. People make a lot of money with directional trades, but you should avoid them as much as possible. Now, what do I first of all mean by a directional trade? If, let's say, you buy a stock at $100 price, right? Then, as soon as the prices start going up, you start making a profit. But if the price of that stock starts falling down, you immediately start making a loss. So this is a directional trade. Why? Because whether you make a profit on this trade or not is entirely dependent on the direction in which the stock moves. Similarly, if you're short a stock, again, if the stock goes down, you make a profit, but if the starts going up, then you start making a loss. Another example of a directional trade. Same holds true if you've bought a call option or if you've bought a put option, because call and put options will also lose value or gain value as the stock goes up or down, right? So all these are examples of directional trades and we should avoid them, because what is the problem with directional trades is that you are not giving yourself any cushion or any room to be wrong. So if you bought the stock at $100, even if the stock falls by 1% to $99, you've also incurred that $1 loss per share or a 1% loss. That means there is no room for you to be wrong. And no matter how much analysis you're putting in, no matter how much confidence you have, how many analysts are saying that they are bullish regarding a stock, or whatever reasons you may have to be super sure that the stock is only going to go towards the upside, it is not necessary that that's going to actually happen. So we have to work with an assumption that this stock is going to go against us. And if I know, if I want to be prepared that if I'm buying a stock at $100, it can go down to, let's say, 97, $96, then I need to execute a trade which does not start losing money if the stock comes to $96. And one perfect example of that is selling a 95 put. So instead of buying the shares of that company at $100, I would rather sell a $95 put and collect the premium. What this does is, as long as the price of the stock stays above $95, I get to make the value of the premium. Those are my returns. Only if the stock price falls below $95, then I start making a loss to a certain extent. So the important thing here to understand is that you are giving yourself a cushion. You're basically not taking a directional trade where you start losing money even with a $1 or a 1% move against you. Rather, you're getting into a position where the stock can go down by $5 or as much as 5% and you still do not make any kind of losses. So that is the advantage of taking non-directional trades, which basically implies trades which don't immediately start losing money as soon as the underlying stock starts going against you. So my way of trading is to stay away from directional trades, because with directional trades I have to be exact. I make money only if the stock actually makes a move in my favor. That means it starts going up if I'm long, or it starts going down if I'm short. Whereas by using a strategy like selling a put option, I'm basically safeguarding myself from this directional impact. And the stock can stay at $100. The stock can go up from 100 to $105, or it can even go down to as low as $95 based on the example that I just mentioned, and I will still stand to make money. So, the first uh, rule to follow to enable the principle that I just showed you is to make sure that we stay away from directional trades as much as possible. So, you should look at selling option premium, and you can do that by selling naked put options, that is the cash covered put options, or you can sell covered calls. Now let's take a look at the next point, which is not to buy any stocks at the top. That means not to buy stocks when they are making a new high. And most traders get this wrong because they are trying to follow the trend, and they want to basically take ride the trend and make profit along with that. The problem with this is that when a stock is going up, it is very difficult to know whether the stock at a particular point in time is on the way to going up further or if it has already reached its peak level. And if you are buying shares at a higher price, which is already, I mean, a stock which has already made a 20-30% upward move, if you're buying at that point, then you're working with an assumption that although the stock has already gone up by 20-30%, it is going to continue going up further. And that is not usually the way stocks move. In general, if you look at stocks, they basically go up or go down, but they don't do it in a straight line. They basically have something called areas of corrections and consolidations. So, our objective as traders is to be conservative, is to be defensive. If a stock has already made a 20-30% move to the upside, then chances are that the catalyst or the reason that was responsible for this upward move is already losing steam. And very soon we will see a peak from where the stock may start moving downwards. That is, it may have a correction or it may start consolidating towards the sideways. So I do not like buying stocks at the peak because when I'm buying stocks at the peak, I'm buying when they are expensive and not when they are cheap. If you buy something which is already expensive, then you are starting at an inherent disadvantage because now you need the stock to go even higher in order to turn a profit. So it is always advisable to buy stocks when they are trading at a discount. And by discount, I mean that they should definitely not be trading at their peaks. Rather, they should be trading at close to their support levels. Support levels are points where the suppliers and I mean the demand comes up all of a sudden, and the suppliers are not able to push down the prices lower. So those are the points where we should look into get into positions, and we should always avoid getting into positions right at the peaks or at the top. So we will look at a couple of examples here in order to understand this concept. So first, you can see here a chart of ALLY, and this is a weekly chart, and you can see that for multiple weeks, for almost a year, this stock just kept going upwards, 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 upwards. So this is a kind of an extreme example that I took because mostly stocks will not do this. So if all stocks we know will continue going up in a straight line for an entire year, then yes, we can buy at any point during the year, knowing that this will continue doing so for the next few months, and therefore we can turn a profit. But most stocks will not do this. So that is why I took this example to show that most stocks will not have this kind of a straight line upward move, which will continue for a year, more than a year. So most stocks will do what is happening here. And this is the AMD chart where you can see that the stock makes an upward move and then it comes back. Then it again makes an upward move. It consolidates for some time. It makes an upward move, consolidates, comes down. And so you can see that at this level, there was a support at around $28. At this level, there was a support around $40. At this level, there was a support which is around at $74, $75. So our objective is not to buy at these peaks or not to buy anywhere when this is going up because you can't be certain when the stock is trading at this price level, you can't be certain if it's going to continue going higher, as we saw in the ALLY example, or if it's going to come down. So we do not want to work with an assumption that the stock which is going up will continue going up, because that is against the rule that I showed you, that we have to be prepared for the worst. And when things can go wrong, they will actually go wrong. If you want to be implementing that rule, if you want to follow that rule, then you have to be prepared for the worst possible. And that is that the stock has already made a significant upward move. So now this is not the time to buy. So you see here, the stock was trading at 30 bucks. It's already made a move till 50 bucks. It's gone up by 40%. And no stocks go up in a straight line or go down in a straight line. So chances are from this move, it is going to come down, because at this point, the stock is already overbought. So when the stock makes this downward move, I would consider this to be an entry point. Same way, if you look at the points here, then you can see that all these points are forming a very, very significant support here. So because this is a significant support here, this is a good entry point, and we can look to enter the position at this level, but not at the peaks. Buying at the peaks puts you at an inherent disadvantage, because we need to compare this to our day-to-day lives. When we are shopping, we look for discounts, we wait for different kind of sales on the malls or online retailers, and then we go and make our purchase, and we feel good about those purchases, because if the normal retail price is X, then we've purchased something at a 20-30% or a 10% discount. The same rule needs to be applied for stocks as well. Just because a stock is going up, assuming that it will continue going up indefinitely is wrong, because no stocks, no company can do that. And therefore, your target should always be to enter into a conservative trade wherein you are buying at a deep discount. If you look at the most successful investors like Warren Buffett or Charlie Munger, these people talk about something called margin of safety. And what is margin of safety? The way they buy shares is they find the value of a company, they do their own valuation as to what they think is the fair value of a company, and based on that they arrive at a fair stock price. And then they have a rule that they would buy the shares of that company if if it's being offered to them at a 50% discount. So what this does is, their valuation may not be 100% accurate, right? But because they are keeping a cushion of 50%, so let's say they value a stock at $200, they will not buy the shares of that company if it's trading at $200. They will go in and buy it only if it is available at $100. So what it means is, even if their valuation was not correct, the company was not worth 200 bucks, it was only worth 180 bucks, still, because they are buying at a deep discount, they are going to make a profit in due course of time. And that is exactly the concept that we also want to follow. We don't want to buy at the peaks. We want to buy when the stock is trading at discounts. And a simple way to understand that is, don't buy at the peaks, buy at the support levels. So as long as you can follow this principle, it goes a long way in making sure that you're not starting your trade with an inherent disadvantage. Because imagine the state of people who bought in here. They bought at about 95 or $100 levels, and for the next few months, 4 or 5 months, their investment would show a $20 loss over a 90 or $100 investment. Means they're going to be showing a 20-25% loss on their positions. We don't want to see that. We don't want to see that. We don't want to start with an inherent disadvantage. If you buy in at the support levels, very high chances are that you're going to see the stock giving you returns within the next couple of days or weeks at most. And that is going to keep your trading psychology in the right place, because when you see a losing trade, then you start panicking, you start losing confidence, you start doubting your analysis, and all that logic that you applied to get into the trade just goes out of the window. So we don't want to trigger the emotional side, the panic side of our trading behavior. We want to have confident trades, and the easiest way to be confident with a trade is to be in the green. So the more trades that you take, which inherently have different cushions, as I explained earlier, which are inherently where you are at an inherent advantage, the chances are those trades will be in the green, and more confidence you will have in your trades, the less you will panic, the less emotionally you will trade. So this is the last point, which basically is to make sure that you apply the strategy to every single trade that you are executing. Most traders don't lose money because they don't understand how to trade. It is because they lack discipline. You can study n number of books, you can look at n number of videos, you can note down n number of points in your trading diary, in your trading journal, but unless you implement those learnings, those principles judiciously and with absolute discipline in your day-to-day trading, you cannot be a successful trader. So every time that I'm about to hit the submit button, I have this running in my mind, this rule running in my mind. Am I working with an assumption that this trade may go against me? What do I do if it goes against me? What is my cushion? So for every trade, I know, okay, in this case, I expect the stock to go up, but even if it comes down by 20%, I'm safe. I'm not going to incur a loss. Even if it comes down by 15%, I'm going to be good. I'm not going to incur a loss. So that is the mindset with which we want to work. People feel that confidence is important to trading, and if you basically are thinking of the fact that the trade can go against you, then you lack confidence. For me, I would say being prepared for the worst and knowing that I have a plan ready in case the trade goes against me, and knowing that the trade will go against me only if the stock makes a very, very nasty 15, 20, 25% move against me. Otherwise, I stand to make money. This very fact, the three facts, that number one, I am not buying at a peak. I bought the stock at a discount. Number two, I have a cushion that even from the current price, the price can fall down by 10, 15, 20%. And that is when I will start making a loss, not immediately. And the fact that I have a backup plan that, okay, in case I own the stock, then I can execute the cycle trade and I can basically sell covered calls against it to further reduce my cost basis. So having this backup plan in case the trade goes against you, these three things actually give me the confidence. It's not the other way around that I'm doubting my initial analysis, but I'm strengthening my initial analysis because let's say I'm 80% or 85% confident that the trade is going to go in my favor. I still have that small 15 or 20% probability that the trade can go against me. But I'm comfortable with that risk because I have the necessary cushion. I am buying the stock at a discount and I have a trading plan which clearly tells me how can I reduce my losses or how can I reduce my cost basis if at all the trade ends up going against me. So all these things collectively uh, basically make you a conservative or a defensive trader and they prepare you for the worst. So we work with the assumption that when things can go wrong, they will eventually go wrong. And once you start working with this assumption in every single trade, you will see that you will stop having losing trades. Or if the trades are even losing, two things will happen. You will be either able to roll out your positions, and by next month, those trades will be in the green, or even if you incur losses, the losses will be substantially lesser than you would have incurred in case you had outrightly bought the stocks. For example, the example that I gave, let's say I bought the shares of a company at $100. If it falls by 10% to $90, then I lose $10 per share or 10% of my capital that I had deployed. But let's say instead of buying the shares, I sold 95 puts and I collected $2 premium for selling those puts. Then first thing is because the puts would be exercised, I would buy the shares at $95 instead of 100, but I have received $2 of premium already, so that further reduces my cost basis by another $2. So my effective cost of buying those shares is $93. So if the stock has gone down to 90 bucks, at $90, I'm making a $3 loss. Whereas if had I outrightly bought the stock, I would have made a $10 loss. So you can see I have reduced my loss to 30% of what it would have been in case I had outrightly bought the stock. And then I can sell the 93 calls, the covered calls, to basically receive more premium and reduce my cost basis. And that way I can convert this losing trade into a profitable one, or I can keep reducing my losses way lower than they would have been had I taken a purely directional trade. So I hope this video is useful and this information you will be able to use in your day-to-day trading, and it is going to help you. be a profitable trader. Please feel free to share this information with your family and friends. If you have any comments or suggestions, they're most welcome. You can leave them down in the comments. I will look at them and respond to that. Uh, so that's it from me for now. Thank you for your time, and I'll catch up with you in the next video. Thank you so much.